All right, today we're going to talk about some of the most interesting articles we read this week and also our original investing commentary and the podcast we did on Validea's Grew Investor blog for the week of April 15th, 2021. Tomorrow's usually tax day, but that was postponed due to the pandemic. So if you haven't sort of started your taxes, don't worry, you're really not behind. Anyway, so to start out, I'll just kind of talk about the article that I did, and it was more of an educational piece for me because it's something that is happening in the market and you're hearing a lot about, but I just didn't really know too much about sort of the workings of these things. And basically I did a very introductory piece on SPACs. So SPACs, just briefly, they are special purpose acquisition companies. And basically what they are companies that come to the market with no product, no business. They basically just have a blank check. So they have cash that they've raised that they can then use to turn around and usually buy another private company and merge them into the SPAC. So it's a quicker, somewhat cheaper way, at least on the surface, to bring a company public. And in the article, I took a visualization from a Wall Street Journal piece that showed just how many SPACs have come online here over the past year and a half or so. One of the things that I think that happened during the pandemic is like these IPO roadshows and stuff like that kind of shut down. But since last March, the market has been very strong. So companies are looking for ways to get quick and easy access to the public markets, and SPACs as a vehicle offer companies the ability to do this. And everyone's got in. I mean, you have Shaquille O'Neal involved with the SPAC. You have Michael Eisner, former CEO of Disney. Bill Ackman has one of the larger SPACs out there. Richard Branson, Alice Rodriguez. So it's a bunch of there's good investors here that are in some of these SPACs, but also there's like influencers and personalities that are trying to sort of drive up interest in these. And so, I just kind of talked about some of the structures in terms of the fees. One of the things is that as a sponsor, so the team that's behind the SPAC, typically they get like 20% equity in the SPAC that they bring public. So it's, they're pretty handsomely rewarded once they find a company to purchase. But they only have 2 years to find a company. And if they don't find a company within 2 years, they actually have to give the money back. And then I just talked about, I think one of the things that I think is sort of maybe being a little bit lost in all this is, SPACs don't have to go through the traditional like IPO regulatory hurdles that, an IPO would have to. And so there's more limited disclosures, there's less transparency. Some of these sponsors can get out and really promote like these ambitious growth rates and valuations and stuff. So I don't know. I just think that there's sort of some risks here that investors should try to understand. And for most people, my conclusion was, unless you're really intimately familiar with maybe the company or the technology or the industry that the SPAC is actually merging with, for most people, they should probably just put these in the too hard pile and wait until things shake out a little bit more to see, who the winners are going to be here. So that was my piece this week.
This was actually a really informative article for me because I know very little about SPACs. Like, for instance, I really didn't know how the compensation of the sponsor of the SPAC worked. And, so you touched on that in the article, how they take 20%, I guess, of the deal once they finally find, their target acquisition. But I think in general, you have to look at SPACs sort of as just a vehicle. And so really what matters is who's behind the vehicle. SPACs are not necessarily good or bad, but the person behind it is probably important. So for instance, if Warren Buffett released a SPAC, which he clearly is never going to do, that's probably a SPAC you may want to take a look at. If some celebrity who has no business, releasing a SPAC is doing it, you probably want to avoid that one. So I think, it's definitely important to understand the fees, but it's also important to understand this is just a vehicle that's being used for a specific purpose. And so the person behind that vehicle or the team behind that vehicle is really, really important.
What do you think? Should we take Validea public via SPAC?
Yeah, if anyone wants to call us, call us up. We're available. So I don't think anyone would be calling though.
We clearly have a $1 billion valuation at this point with our with our podcast traffic and
in our own minds, at least we do. Right. Yeah. This podcast we started or whatever, we think this thing's worth a ton, but
yeah, exactly.
The market may feel differently than us.
What was the podcast this week we did?
Yeah, we did a great interview with Eric Crittenden of Standpoint Funds, and the topic was all weather investing, which I think is really interesting to think about right now because we've had, if you're most people think investors should just have stocks and they should have bonds, and if you've been a stock and bond investor since 1980, you've had this massive tailwind where interest rates have been falling the whole time, so bonds have just been going up, stocks have been doing really well, and so you really haven't needed anything else besides that. But that sort of misses that there's been big periods in history where stocks and bonds have gone down together, the 70s being an example. So there's been these periods where the stocks and bonds weren't necessarily enough to reduce risk, and some other things may have added to a portfolio. So we talked to him about the topic of all-weather investing, the types of things that might be in an all-weather portfolio, some of the behind-the-scenes details on how you create the portfolio, how you weight the positions, and we just talked about the general pros and cons of that approach and what goes into it. So I thought it was a really interesting interview.
I liked his analogy of the SUV. He basically, when we were talking about all-weather investing, he's like, think back to, we used to have like the station wagon. You would load all the kids up, but the station wagon probably wasn't great at, keeping up with the Corvette necessarily on speed or maybe getting through the snow. But then, a Corvette, it might be great to drive on the highway, at 7 o'clock in the morning and really open it up. But, clearly that's not going to be good in like bad weather. So he was kind of working through these examples of like cars. And basically he came to like his example of the SUV that said, you can put the kids in it. It's going to get you around town. It has pretty good speed. And so that's kind of like what an all-weather investing portfolio is supposed to do. It's really just supposed to be good in any type of environment so that the investor can stay invested in the strategy over time and get the most out of it. It's not necessarily going to be the fastest one. It's not going to be the most powerful one. It's not going to be, maybe the one that fits the most people. But in terms of being diversified for all those different types of environments, that's really what an all-weather strategy is made to do.
Yeah, and we all tend to, one of the downsides and the challenges of all-weather investing is we all tend to judge ourselves by the S&P 500. And so this is such a different approach than the S&P 500. It probably shouldn't even be, judged in the same category as the S&P 500. But the challenges of these approaches is they look different. And there's going to be times where the market's on just a massive run and you're going to be trailing. But then there's going to be other times where the market's down a lot and you're doing a lot better. So just separating yourself from the S&P 500 is probably one of the challenges with this type of approach.
What article stood out to you this week?
There was a great Bloomberg interview with Howard Marks, and I thought anytime he speaks, I try to listen, but he's great about the fact that he's been willing to pivot and learn over time, and I think that's really, I don't know if you listen to, or I listened to it, but it's also in writing, like his 2 memos ago, he did a memo on growth investing. That I thought was really, really good because it shows that he's sort of evolving on the topic. He tends to be a value guy like I do, and he's sort of rethinking, how we're valuing these growth companies, and maybe what's going on is more justified than all of us thought. And that's a really important characteristic in an investor is this ability to sort of take what your core beliefs are and maybe to rethink them or to look at things in a different way. But in this particular article, he was just talking about, or in this particular interview, he was just talking about how things have gotten a lot harder right now. Things may have been, there's certain times with any investment strategy where things seem a little easier, but with valuations the way they are in the market, whether you're a distressed investor like he is or whether you're an investor like us, things are a lot harder. And he was talking about how that's when you really distinguish yourself as an investor. When you go through these periods where things are difficult, what you do and how you handle those periods is really important. And then the second point I thought that was really good from there is he was talking about this idea that we've never seen stimulus like we're seeing right now ever in history. And, one of the things that I think is really important to do, and I try to do it myself, is whenever you can say anything is going on in the market and we've never seen it before in history, you probably can't draw any definitive conclusions about it. And that's what he was talking about. So I try to ask myself the question whenever we're going through anything, have we ever seen this before? And then if I have a strong opinion about how it's going to end, I probably shouldn't have that strong opinion, because if we've never seen it before, none of us know how it's going to end. And I think that was a really important point with respect to the stimulus he made, which is none of us know. I mean, there's these obviously doom and gloom people out there who think this all ends in a catastrophe, but none of us really know because we've never done it before. So there's no evidence from history to show us how this might end.
Yeah, I mean, given the fact that Oaktree is a distressed debt, distressed company type of investor, he makes the point in here that, they're trying to, the fact is every strategy goes in and out of favor, he says. But, you have to be resourceful and maintain your standards. And it's really challenging when you're a value investor looking for, cheap assets or cheap stocks or companies, and you have sort of what's going on in the market, which is driving valuations, a lot higher. But I think his point is, they're trying to maintain their investment methodology and not, overpay for stuff. But that probably also means that, and I don't know this for sure, but that their, performance may not be what, I don't know, but it just may be a challenging time to find those distressed debt type of opportunities to actually put money to work.
And we struggle with that too. I mean, we're value investors in a lot of our models. And what happens when you're a value investor and there are no more values? What do you do? I mean, you don't want to necessarily be in cash because the market can keep running for a period of time. So it's a challenge, and it becomes, like he said in the article or in the interview, it becomes much more difficult when your universe is smaller because, things have just run up a lot. What was your article this week?
So yeah, it was an article in the New York Times, and it was titled "How 10 Prominent Economists Are Think About Overheating." And basically, it was a article about inflation expectations, and it was basically surveying all these different leading economists and sort of what their thoughts are. And, I mean, right off the top, I mean, it's you get very different opinions from all these different economists, which is kind of what you might expect, but very rarely do you get like a consensus view, although I do think there was some maybe overarching points, and I'll try to bring those out here. But, just in terms of, I mean, one, the article did a good job of defining inflation. So, you have like PCE inflation, which is, personal consumption inflation, and that's an inflation measure that the Fed likes to look at. And then you have break-even inflation, which refers to level of future inflation priced into the Treasury bond market in terms of inflation-protected securities. So there's two different types of, inflation that investors sort of can look at. We're more familiar with like the personal consumption inflation, which shows up in, the goods and services that we're buying. One thing with core inflation though too is that, that excludes food and energy. So, a lot of times when you hear the word core inflation, you wouldn't think it would exclude those things, but it does. But anyway, so just in terms of a few that sort of jumped out at me, Gregory Mankiw, who's a popular economist, he said he would be concerned if core inflation rises above 3% for a 12-month period. Larry Summers said, I think there's a 1/3 chance that inflation expectations meaningfully above the Fed's 2% target will become entrenched, a 1/3 chance that the Fed will bring about substantial financial instability or recession in order to contain inflation, and a 1/3 chance that this will work out as policymakers hope. So he's kind of, splitting those three things, a third down the middle in terms of what we might expect coming out of all this. And then you had Wendy Edelberg from the Brookings Institution. She said the level of economic activity will temporarily rise above its sustained level for a time, and inflation will rise above the Fed's target. If you want to call that overheating, I think that isn't in and of itself problematic. In fact, I think it's making up for some of the lost economic activity is beneficial. So, her point is that, even if we do go above that target rate, it's probably going to be okay because, we're making up for lost economic activity that the economy hasn't generated, over the past few years. One of the sort of just the sort of common thing I think that I took from the article is if you got, let's say 3.5, 4% inflation and it persisted. So it's consistently higher, and that sort of that inflation level gets stepped up. That could be a little bit more problematic, and it might cause the Fed to start to raise rates, which, we know when that happens, it sort of is a sign that, they're going to try to slow down the economy, and that could, obviously put us into a contraction or recession. So anyways, that was a lot of different interesting thoughts in there. It was a pretty meaty article about inflation.
Yeah, for me, whenever I see an article where I've got a bunch of people that are a lot smarter than me disagreeing about stuff, typically that means I probably, don't have a strong opinion either one way or the other. But what's interesting is when you see people that are, this quality of economists, they're really disagreeing about two different things, which is what makes it hard. There's sort of two different problems here. One is, what is inflation going to go to? Some people think inflation is going to go a lot higher than others. And two is, at what level does it actually become problematic? And they disagree about that as well. So, not only do I have to try to figure out what inflation is going to be, which is very hard to do. But in addition to that, I try to figure out what is the impact and at what point does it become problematic, and that's a tough thing to figure out as well. So for me, this is definitely beyond my my level as an economist.
I guess your honors degree in economics isn't serving you well here for these this inflation.
Well, one, I forgot all of it, but two, it turns out that a lot of the stuff we learned in economics, it turns out to not be true with what's going on with MMT and stuff like that. So I definitely need to check out of this one.
Yeah, good point. All right, guys, thanks for watching this week, and we'll see you next time.
Thank you.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.